Hey, how's everyone doing? I hope you're all doing great. Welcome back to the channel. We'll explore a scenario that almost nobody is talking about right now, the possibility of a more deflationary environment rather than an inflationary one. We'll also talk about the role of geopolitics and how global tensions can accelerate moves that were already building up. And of course, we'll bring all of that down to the real market, looking at Bitcoin, price structure, and volume to understand what the big players are actually doing. Because there's one key idea I want you to keep in mind throughout this video. An asset can go up even when the overall environment is becoming more fragile. So let's take it step by step, connecting each piece until we see the full picture. Let's start with the basics, the data, because at the end of the day, everything begins there. And this isn't just any number, it's a very clear line. Above 50 means expansion, below 50 means contraction. So we're no longer talking about slower growth, we're talking about declining activity. And why does the services sector matter so much? Because it's the backbone of modern economies. It's not just tourism or restaurants, it's technology, healthcare, finance, education, logistics. When that starts to cool down, everything else tends to follow. And this usually doesn't happen all at once. It starts slowly and then it accelerates. Now, let's move to the second point. Wages. Average hourly earnings are declining, and this matters more than it might seem because modern economies run on consumption. That's deterioration. Now we move into a key part of the video. Over the past few years, everyone has been obsessed with inflation, rising prices, central banks hiking rates, loss of purchasing power, but the data is starting to point in a different direction, deflation. And this is far more dangerous than most people think, because deflation isn't just prices going down. That's the nice version. The real version is this: prices go down because nobody is buying. Look at what we have right now. Activity is declining, wages are weakening, demand is cooling, inflationary pressure is fading. This is not a strong inflationary environment. This is starting to look like something else. And deflation has a serious structural problem. It feeds on itself. And now we get to the catalyst, the accelerator of all this: geopolitics. Markets don't move on economic data alone. They also move on expectations, and right now there is one expectation starting to gain weight: a potential major military escalation in the Middle East. When the market starts pricing in geopolitical risk, the pattern is often similar. First, uncertainty decline, then a technical rebound if there's a pause or negotiations. Finally, the market chooses direction based on how long the conflict lasts, but what really matters isn't just whether it happens or not. What matters is that the market is starting to price it in, and that affects everything: commodities, currencies, equities, crypto. This is where everything starts to connect. But what really matters isn't isolated spikes, it's sequences. When you see several consecutive candles with high volume, that's where real intent shows up. That's where real moves begin. And then there's a more advanced layer, net volume. If you see strong buying volume, but price barely moves up, it means someone is heavily selling into that demand. They're absorbing it, and that usually points to one thing: control of the range, control of price. And when that happens, the market isn't ready to move freely yet. And now we get to the most important part, because all of this is great, but the real question is, what do I do with this? My personal stance right now is clear: caution. I'm holding liquidity, not because I don't see opportunities, but because the overall environment doesn't look favorable to me. And this is important to understand. Not being in the market is also an active decision. I'd rather miss a 15% upside move than get trapped in a 40% drawdown. Because in the end, this isn't about being right, it's about managing risk. And that's what separates someone who survives in the market from someone who disappears. And that brings us to the main takeaway I want you to leave with today. The market is not black or white, it's not simply bullish or bearish. It's a constant balance between economic data, expectations, global risk, and price behavior. If you enjoyed the video, leave a like, subscribe if you haven't already for more no hype content, no false certainties, just thoughtful market analysis, step by step, day by day. See you in the next video. Take care, stay sharp, and keep a cool head. Goodbye.